What is going on, guys? I wanted to give you a rundown of how I view liquidity in the markets. Without liquidity, no market will be able to move price from one objective to another objective. It's the lifeblood of all markets. And intraday, there will always be an objective for price to run to buy stops or to sell stops or to rebalance fair value to imbalances that have been created. This is general market mechanics. If you'll see on charts from over and over again that price will move from three phases, from accumulation to manipulation to distribution. It's always in one of them three phases. And you need to work out which phase the price is in for you to be able to understand how to execute the highest probability trades. Now, a ranging market or accumulation is essentially where price has no real direction apart from up and down. This is the most basic form of accumulation, where price will be reacting off a support level and price will be bouncing back off a resistance level. And what essentially this is doing is this is building up liquidity on both sides of the market for price to manipulate and to be able to distribute in another direction. So this here would be accumulation. The next phase of a market is the manipulation phase. And this is always found around key levels and around at key times. So London Open, New York Open, such as this. The next phase will be the manipulation phase, where you will see a sweep of sell stops or buy stops, and then you will see a distribution in the other direction. So this would look something like this, where price comes down sharply and then moves sharply back into the range, where this is taking out all of this liquidity down here for price to then move back into the range to distribute higher. So the psychology of this is that there's going to be many traders here that are, number one, going to have their stop losses beneath these lows here. So the market is targeting these stop losses to then fill buy positions. So as the market comes down, and there are also many breakout traders that are looking at this level for a breakout to take short side positions to the downside. So a sharp move down is a trap. It traps traders in both sides and then it sharply moves back up, back into the range. That is the manipulation leg. The next phase of the market is the distribution. This is the real intention of the market. This is what price wanted you to do the whole time, is to go the opposite direction to how the market makers want you to be. The next phase is the distribution leg, which is essentially a move back into the range, a short retracement, and then a push higher. That is the three phases of any sort of market. And that is how liquidity is generated over and over and over again. And you need to understand at which phase the market is in. And once you understand which phase the market is in, you can then capitalize and understand that not to get involved. The two legs you want to be involved in is either the manipulation or the distribution. You don't want to be involved in the accumulation phase, as this is where many traders get chopped up. And this happens on every time frame, and it happens over and over and over again. It is the one pattern that will always remain because it's the psychology behind the markets. Always look where the most pain is in a market. If we go to the NASDAQ chart, for example, you'll see this happens over and over again. For example, if we go back to Friday's price action, you'll see, here's an example. On the 15-minute time frame, you can see that we have a breaker structure here. We have an imbalance that's created down here. And we have price creating a new high. So at this point here, we have a high and we have a low. And we have an imbalance that's created showing the intention of the market, which is bullish. So if we drop down to the lower time frame, you can see the price action that took place. You can see price here is correctively moving down in nature. So if we mark out the imbalance that's created here, and you can see what happens is price is accumulating in a very corrective in nature, and it manipulates down into an imbalance that was created. So there are traders that see this high here and they'll be short as of this point. So you can see that essentially what happens with price is that it comes lower, tests an imbalance, it trades higher, essentially confirming here that actually it no longer wants to trade any lower. And you can see that price will accumulate some further. And you see at this point, you have an accumulation, you have a manipulation first here at this point, and then again at this point here. And the real intention of the market was to not go lower, but was to actually go higher. So you can see this whole price leg here was an accumulation, and you can see the price action that followed. You can see this whole region here was the accumulation phase. You can see that this leg here was the manipulation phase. And you can see that this phase right here was the distribution phase. This pattern happens over and over again in the markets. And you can see you can get involved in two directions. And in this specific scenario, you could get involved in the buy, but you can also get involved in the sell. So that's liquidity in a nutshell. If you want me to go over more, just let me know. And yeah, put it in the suggestions chat and I will get back to you with the video.